Most people buy the wrong crypto miner for one simple reason. They obsess over daily profit. They open ASIC miner value or an equivalent website that does profitability, and they see a miner making $50 a day and they think they're gonna make bank. If you've ever used ASIC miner value, you already understand why this happens. It is a brilliant site. It gives live income estimates, but the way most people interpret the information is backwards. They treat today's daily profit as if it's a fixed yield. Mining is not a fixed yield. Mining is a competitive market. Welcome to Crypto Coach Will, where we bridge the gap for everyday investors wanting to build real wealth in crypto. I'm Will Wright, the founder of Mining Store and Imperial Wealth, two of Australia's leading companies in the crypto space. For over a decade, I've helped everyday investors safely and securely set up in the cryptocurrency market so they can build long-term sustainable wealth. In this podcast, we break down the complexities of the cryptocurrency market, everything from investing, trading, DeFi, and even Bitcoin mining. Let's get into it. Daily profit is the worst first metric to use because it ignores the biggest driver of mining returns, which is competition. And it also doesn't account for network hash rate and difficulty. Here is the simplest way to think about it. Imagine there is a puzzle to be solved every single day, and the reward for solving that puzzle is $50. If there are 10 people competing and you are one of them, your chances of winning is about 10%. But if 90 more people join the network, your chances become about 1%. So far, that should be simple. Now, make it realistic. Efficiency changes everything. In mining, the new people do not show up with the same gear as the last people. Mining output or computing power is measured in terahashes or hash rate. The first generation of 10 miners might be doing something like 10 terahashes. So the total network hash rate would be 10 terahashes, your percent being 10%. However, when the next wave of miners come in, they might be doing, say, 50 terahashes. And if we say 90 miners come onto the network, that's an extra 4,500 terahashes coming onto the network, leaving your new percent of the network at 0.2%. Now, that's roughly a 46x collapse in your share of rewards. And that is what daily profit hides. And this is why the $50 a day altcoin miners almost never stay at $50 for very long. The market piles in and the hash rate and competitiveness turns against you. Now, this scenario is so common with brand new altcoin miners, and it's the biggest issue I see beginners make. It stems from using daily profit as a metric for future projections. It's the complete wrong way to do it. Now, in this episode, I'm going to give you a cleaner framework than daily profit for you to use when looking at mining. We'll look at why daily profit pushes beginner miners into high-risk altcoin miners, why daily profit is still misleading even if you stick to Bitcoin mining, and what you should look at instead if you want to invest like a professional seasoned miner. So let's look at point one, why daily profit is a trap and pushes beginners into altcoin mining. When a new coin looks insanely profitable, miners will rush in. Network hash rate will increase and so will difficulty to earn rewards. I showed you this in the previous example and we showed how profitability gets smashed by competition. And it really does matter because a lot of the $50 a day altcoin miners are costing people $20,000 to $15,000, sometimes more to purchase that type of miner. And the profitability can collapse so quickly. But why is this not a concern for Bitcoin mining? Bitcoin mining has been running for over 15 years now, and the network is already enormous and highly competitive. So it's harder for a sudden wave of new miners or hardware to distort returns the way it can on smaller altcoin networks. Let's take a look at the size of the Bitcoin mining network to verify this. The Bitcoin network hash rate is sitting at around 980 to 1,000 exahashes. At the moment, for those of you that don't know, hash rate is simply the measure of output a Bitcoin miner has. It determines how much Bitcoin that you will mine on a daily, weekly, or yearly basis. But how many miners is 980 to 1,000 exahashes? One exahash is 1 million terahashes. So 980 exahashes is 900 million terahashes. 980 million terahashes divided by, say, the average miner would be 100 terahashes means there's 9.8 million miners out there already competing for Bitcoin rewards. That scale is why Bitcoin mining tends to be structurally more predictable than small cap networks, where a single new ASIC generation can completely rewrite the economics overnight. To put it in perspective, it is significantly harder to even double the network hash rate of the Bitcoin network, let alone do something like a 10x in a short period of time. There simply just is not even enough computer chips available in the world to do this over a short period of time. So let's look at the second point, why daily profit is still a bad metric even for Bitcoin mining. Even if you choose Bitcoin, daily profit can still mislead you for two major reasons. The first reason being you're not selling what you mine on the day that you mine it. Most serious miners are not mining Bitcoin to sell it immediately. They're accumulating it with the potential of an upside in the valuation of that Bitcoin. If you mine Bitcoin at a price of $142,000 per Bitcoin, which is today's price, and you sell it years later, then you're actually getting a much higher evaluation. And doing things based on today's price severely undervalues your strategy. A better approach is to model scenarios including your expected holding period and sell price, not just today's snapshot. The Mining Store website has a calculator available which actually allows you to put in the price that you want to sell your Bitcoin at. Say you might put in that you want to sell it at $250,000 per Bitcoin. This is a much better way to measure your profitability. Now, the second reason is the fixed costs, which creates an operating leverage. Mining has mostly a fixed daily cost, being your electricity. For example, your electricity costs, say, $10 a day to keep your Bitcoin miner running. At today's Bitcoin price, you would be making about $4 profit. That means your revenue is about $14 per day, because $14 of revenue minus $10 of cost is a $4 profit. Now, if BTZ's price doubles overnight, then your revenue is going to double, but your cost stays the same. So revenue goes from $14 up to $28, but your cost is still staying at $10. Now your profit is $18 per day. So profit did not double from 4 to 8. It actually jumped from 4 to 18, which is a 4.5 multiple. That operating leverage is real, and it's exactly why daily profit today is not the full story. Now, if you're sitting there and you want to sanity check a miner choice properly, including power rate, hosting, tax position, and a realistic assumption around difficulty and hardware cycles, then feel free to book in a call using the link in the description. We will make everything make sense for you, and we will tell you exactly what we think you should do. Now, if you want to do a sanity check on a miner choice that you're thinking about purchasing and making sure that you're doing the calculations on power, hosting, tax position, and a realistic assumption around difficulty and hardware cycles, then book in a free consultation using the link in the description of this video. We'll tell you if it makes sense for you, and if it doesn't, we will tell you exactly what you should do. Now, I want to make a quick honorable mention to some other aspects that daily profit calculators usually ignore. Daily profit rankings typically do not reflect your full investment picture. It will leave out things like the depreciation and potential tax treatment that business structures and accounting measures can benefit for your mining operation. It will definitely leave out things like hardware resale value and life cycle planning. It's not going to give you any form of strategy such as accumulation, times to offload Bitcoin, best times to buy Bitcoin miners, and anything like that. So make sure you reach out to experts, whether it's Mining Store, Australia's largest and most trusted provider, or someone else that you find. Speak to an expert before you scale into Bitcoin mining. Now, I see the same pattern over and over again. A first-time miner finds something like ASIC miner value, a website online that shows profitability, and they see a miner making crazy daily profit. They spend an absolute fortune on that miner or multiple miners because it looks great on that day. Two things then happen. A more efficient miner model hits the market, and now the early hardware is fighting an uphill battle. Or the altcoin that is being mined crashes in price, and the whole operation turns to shit. They did not buy a mining operation, they bought based on a screenshot. Meanwhile, the boring Bitcoin miner that they ignored might have stayed productive for years because Bitcoin's ecosystem and hardware cadence tends to be less Wild West than small networks. I do want to make a note that it is possible to mine altcoins profitably. However, the situations are far and few, and the risk is substantial. Rarely will mining store even supply altcoin miners for that reason, and we will always highlight the potential risks involved. But that's not to say that there aren't altcoin mining situations that can be profitable. So here is the core message for you. Daily profit is not a yield. It is a moment in time. Mining returns depend heavily on competition, which shows up as hash rate and difficulty. Efficiency upgrades can crush your share of rewards, and in our example, it went down from 10% all the way to 0.2% of reward share. Bitcoin can scale. It's roughly at 980 to 1,000 exahashes already, meaning the network is far more established and it generally produces more reliable projections than brand new coins. Even in Bitcoin, daily profit is misleading because of the holding strategy and the fixed operating leverage. Hopefully this video has opened your eyes to the things to consider when getting into Bitcoin mining or mining in general. So if you take one thing from this episode, let it be this. The number one mistake people make when investing into crypto mining is choosing a miner based on daily profit. If you want to start mining properly and avoid the expensive beginner traps, book a call through the description in the video. We've been doing this for a decade now, and we will help you build a plan that actually matches your goals, your risk tolerance, and the reality of mining. Hopefully you enjoyed this video. Make sure to follow us on this YouTube channel and hit a like or even leave a comment on your thoughts. We'll see you in the next one. Thanks for tuning in to Crypto Coach Will. If you got value from today's episode, then make sure to subscribe so you never miss the latest tips to navigate the crypto market. If you're ready to take crypto investing to the next level, check out the links below where you can book in a call with my team of experts. We place strong emphasis on educating before investing in the market, so take advantage of the knowledge they have to share. Don't forget to follow us on socials @CryptoCoachWill, and I'll catch you in the next episode.